how to trade on ranging days. That is the topic du jour. If you are trading on a ranging day, as it is today on Bitcoin, how do you trade on ranging days? What does that even mean? Well, ranging days are days when the VRE of the asset's value is more than 2%. Or to say it the other way around, when the asset's value is 2%, when the VRE width is 2% or more of the asset's value. And today, on Bitcoin, for example, you have a wide ranging VRE width at 2.35% or so on the daily range of the VRE. And again, the weekly range is very tight, at around 0.04%. So the weekly range is trending, and obviously we've seen a rather impressive weekly movement so far with trending moves, obviously mostly to the upside, although of course there have been a number of pullbacks as it has chugged along, right, on lower time frames. Plenty of little dips that liquidated a lot of over-leveraged longs, right? And by the way, plenty of liquidations of shorts who were simply buying whatever random level their chart art or their lagging information told them to sell, because they were sure that that would be the level to sell at, even though they had no clue about what was actually happening with the volatility, the entropy, the probability, or the statistics. So Monday, at the start of this week, on Bitcoin, it was a trending day on a trending week. And I said in a video, if you look on this channel, I said, and I made it very clear, that the day would very likely see trending moves. And boy, did it. Right, that was the beginning of the pump of the week. And sure enough, it was a very trending day to the upside. Right? And you could see that very clearly with volatility, with entropy. All the probabilities and statistics were pointing towards the upside. And lo and behold, price go up. And the next day, it was a ranging day. Because again, the VRE width had expanded significantly due to the rise over the course of the day on Monday. So the Tuesday range was quite wide, relatively, and it was a ranging day. It was right about 2% actually at the threshold. And it was indeed a ranging day, although there were a lot of trending moves, but they were mostly up, but there were also some moves down, right? There were trending moves down. So it was a very good day for scalps, up and down, up and down, up and down, with a, you want to call it a bias, with a higher propensity of probabilities to the upside. And it ended up on the upside. But it was very ranging, and if you look at it on lower time frames, you can see that. Right? And on Wednesday, it was actually another day of trending day. Why? Well, because the way Tuesday finished off, right, squeezed the VRE width a little bit back down. So it was around 1.5% or so. I forget the exact number, but around 1.5%. So technically a trending day. And boy, was it ever, right? Trended up, gave a nice snap back. Within half an hour, you saw a $4,000 move down from wick to wick, and then bounced back up and kind of wandered around sideways, a little bit up towards the end of the day, finishing up on the day a little bit up, but quite flat overall. And I mean, it was an up day, yes. But like if you look at that 4-hour candle, where it was the big drop and snap back, it was a very flat candle. I think it was like minus 0.02%. So basically a flat candle. Okay, and then again, it finished up. So the day ended up very nicely. It was like a 9.5% move if you don't include the wicks. And well over 10% if you do include the wick. And then today, once again, because of that massive move yesterday, it is a ranging day. What does that mean? Well, that means that again, VRE width is over 2%, right? And so of the asset's value. Well, why does that indicate that it'll be a ranging day? Well, because of the probabilities. If you know how to read the VRE chart, it's very clear, and you can see for yourself that days that are ranging tend to be exactly that. And days that are trending tend to see a lot of trending moves, right? And so how do you trade ranging days? Well, in a way, ranging days are kind of easier to trade than trending days, at least for some people. Why is that? Well, because the prices tend to go up and down quite a bit. Or, even if they don't tend to go up and down, even if they tend to move in one general direction overall, there tend to be multiple occurrences of opportunity to get in on longs and shorts, or at least to get in on trades in one direction and then hold off until the next occurrence of opportunity comes along to re-enter in the same direction, right, once the information is confirmed. So what does that mean? Well, that means if you scalp on lower time frames, like 15 minutes and under, then you are very likely to see occurrences of opportunity on ranging days, multiple occurrences of opportunity, where normally trending day, well not normally, where on trending days you'll see less of those occurrences of opportunity to go in both directions, although you certainly can, but typically on a trending day there'll be a stronger probability to one side or the other, and that's where you would put your risk on, and you will very often be in trades either longer or get out before moves are over. Whereas ranging days let you easily, target entries and exits with solid caps, so that you don't put your capital at risk while you're in the trade, because you know precisely what your targets are and where you probably should get out of the trade. Okay? Why is that important? Again, that's important because it lets you limit your risk. It lets you limit any potential loss. And at the same time, it lets you maximize your profit, right? Your potential profit, if you know how to manage the risk well, you know how to enter and exit correctly, you should be able to maximize your profits quite well, given that you be wondering when it hits a particular target, oh, is it likely to keep running up right now, or is it likely to level off before the next move? Right? And in either case, when you're looking at trading on any given day, something like a ranging day should just give you a sense, you can call it a bias if you want again, it should give you a sense of the probabilities of where to put your risk. Should you be going in full bore to the upside or the downside? Right? Should you be putting in half your position, or should you be willing to put in half the position counter to the trend? Well, when it's a ranging day, it's not a trending day. So you put in your position, full bore, whatever direction it's going. And when it's going up, it's going up. When it's going down, it's going down. And there's no reason to cap the amount that you put in based on the probability that the trending move will go against the probabilities. Right? So for example, if it was a trending day where the probabilities seem to be to the upside, then any move you would take to the downside normally would be wise to limit any shorts you would take to, let's say, not more than half of your capital position, right? So that way you limit any potential loss by being in a short that ends up going against you to not more than half your capital position base, obviously, for that trade, right? You never trade more than you can actually afford to lose, in their whole amount that they have on their exchange. But here's the thing. The only capital you should have on any exchange is the amount you're willing to lose. So let's say you have, whatever, $1,000, okay? $100, I don't care. And you put 10% of it on the exchange to trade, okay? You put $10 on the exchange. Just, okay. So, you have $100 and you want to trade 10% of that. Okay. So you put 10% of that on the exchange, okay? And so you got $10 on the exchange that you're willing to trade with. If at the end of the day, or at the end of your trading session, however long that is, you end up with $9.50 or $10.50 or $11 or $8 or $12, whatever it is, $20, right? Then $20 means you made 100% gain. That's amazing. Congratulations. Right? That's not going to happen every day. But whatever it is you won or lost, at the end of the day, you should move your capital off of the exchange and put it back into your wallet. And if you're wondering why that is, it's because any amount that you leave on the exchange is, as the old saying goes, the house's money, right? Or as they say in crypto land, not your keys, not your crypto. Which means if you don't actually have your crypto on your hardware wallet, right, or your paper wallet, or any other secured wallet, offline, right, in your possession, in your custody, wherever it is, if it's in someone else's hands and they have the seed phrase to that account on their exchange, and they have the recovery password to that account on their exchange, it's not your money, right? Technically, it's theirs. And if they decide one day to stop allowing withdrawals, which has happened, then, you're screwed. You don't have access to your crypto until they decide to allow you to have access again, which, if they go belly up because of poor management, like what happened with FTX a year and a half ago, well, you're screwed, right? That's what happens, and that's happened on many exchanges. And by the way, even if you do manage your money well, relatively, keep in mind other shenanigans can happen, even on quote-unquote regulated exchanges. What do I mean? Well, yesterday, for example, when Bitcoin was having its massive run-up, and spiking all the way up to 63, 64K, whatever it was, before it came smashing down, guess what happened right around that time? Coinbase became unusable for a lot of users. Oh, I thought Coinbase was a regulated exchange. Yes, they're a regulated exchange. And yet they also have shenanigans. As does literally every other crypto bucket shop or trading exchange. Well, what do you mean? Well, it just so happens when there's a lot of trading volume on pretty much any crypto exchange, one thing you'll notice if you're a regular crypto trader is that whenever there's a massive amount of trading, suddenly, for some magical, mystical reason, the exchanges become incredibly hard to use, very slow and sluggish, even impossible to use, and will lock you out. Does this happen every single time on every single exchange? No. But it does happen a lot. And it does happen on a lot of exchanges. arguably most of them, especially the ones that people consider legit. It happens on Coinbase, it happens on Binance, it happens on Bybit, it happens on OKX, it happens on, you name a big exchange, relatively, it happens there too. So you are not protecting yourself by leaving massively open, massive positions open on exchanges, right? And it is super important to be aware that when times get crazy, any sluggishness that you detect in the system should be a red flag to you to close your positions and wait for the insanity to pass. Doesn't matter if you're in massive gains or not. If you just started your move, whatever. By the way, if things are getting sluggish at all and you're thinking about opening a position, probably a better idea is not to do that. Go take a break, come back in 20 minutes before you open a position. See how the exchange is operating. See if it's still operating fine. Scan the Twitterverse for anybody screaming that the exchanges that you're using are working well or not, because people will definitely tweet about it. So that goes, by the way, for ranging days as well as trending days. It doesn't matter. What matters is when there's a lot of trading activity. You will see that happen. So to avoid that headache, one, don't keep more than a small portion, or whatever portion of your capital you're willing to lose on your exchange, and do not keep it on there once you're done with your trading session. Get it off the exchange, secure it in your wallet, and put money back on the next time you want to trade on that exchange. That way you don't risk losing it all if they have some problems, like they go belly up or have other issues, right? They freeze withdrawals for some reason, which again happens regularly, even on the quote-unquote leading exchanges. So that said, I hope you take this under advisement as not egg boiling advice. And remember, folks, love your animals. Happy trading.